Where do we start? I mean, we're all yours. So we could take your pick on what our starting point. What do you think is the most important thing to note right now?
So good morning, David. We at Tamohara believe that if you want to invest in the Indian markets are among the few markets that give very good 13-15% compounding stories. And one has to be in the Indian markets for the long-term potential. We will see crises. The Indian market has seen several of them. And I think we are very well placed currently with very limited downsides in the market. We've seen GDP growth in the first quarter of nearly 7.8%. The corporate earnings that we are seeing right now, the companies, about 250 companies have declared their results, and they've shown new earnings growth, PAT growth of about 25%. Of course, we are flat Q on Q. We did come off a base quarter, which saw maximum margin compression, 2Q of last year. And we may see margins normalize, but we think corporate balance sheets are very strong. They're deleveraged. We are coming off a very good growth environment and robust tax collections as well, which will protect the macros. So this is a backdrop of the Indian markets. And I think every correction is a great opportunity to invest in good compounders.
Right, and let me just challenge that a little bit and maybe just give your thoughts on this as well, because, a market like India, for example, many people keep telling us it's expensive, but when you look at earnings growth, it doesn't look as expensive. With bond yields, though, globally where they are, I mean, we get into things like equity risk premium, for example, and it just makes, on the surface, it just makes more sense to leave your money in fixed income than an expensive market like India. What's the pushback there?
Yeah. So, yes, you're right. Debt is very attractive, and every portfolio should have an allocation to debt. These are great rates to lock in your debt allocation. I think where equity is concerned, it's, long-term value creation and wealth creation happens only in equities. So it's every portfolio has to have a clear balance. And, that's what I would recommend at this stage. On the other aspect that you raised about the valuations in the Indian market, you're right. I mean, it's challenging finding value stories in India. But honestly, I think it has always been very challenging finding value stories in India unless you're a very, very deep value investor and you invest way ahead of the curve. But I would urge you to look at India as a growth market. And do have a margin of safety, right? Which is why active fund managers really make that alpha in India. So the whole point is that in India, you find very few value plays. You buy India for growth. You buy it with a margin of safety, and you play your portfolio weightages and stocks accordingly.
Right. So give us your top sector pick then.
Yeah, so we basically are very convinced on the high-end consumption categories. We have seen weakness in staples, but if you look at high-end consumption categories, and if you saw the pre-results that came out from the jewelry companies, right, they showed phenomenal growth. You look at the way high-end cars are doing, luxury real estate. So we think that's a decadal opportunity. Apart from high-end consumption categories, we also like pharmaceuticals. You've seen the US story play out very well. Domestic has been good. In some months, volumes are challenged, but we think pharma is a long-term structural story. And we also like the real estate and infra play, which has been spearheaded by the government capex, and we've seen private capex also pick up. So I would say these are our top sectoral bets.
Okay, now the final question is, I noticed you're 8 to 10% in cash. Just give us context. Is that high or low, relatively speaking, to historical averages, at least for you guys? And I think follow-up there would be, do you expect it to go up or down in the next, let's call it 6 months?
So clearly, I mean, 8 or 10% is slightly on the higher side, but we like to keep gunpowder ready so that we can deploy it when we get opportunities. And we are expecting a volatile market. We have elections, state and central elections coming up. So we will rotate our portfolio. And, around these levels is where we do see cash.